Have you ever wondered what really happens when a giant company decides, hey, we're selling off this whole chunk of our business? I mean, it's a huge deal, right? It's definitely not as simple as just slapping a for sale sign on a factory. No, there are very specific rules for how companies have to report these massive changes. And today, we're going to dive into the global rulebook for that exact situation, IFRS 5. All right, let's make this real with a quick example. Imagine some huge corporation. Let's say they own a whole chain of coffee shops. And one day the board decides, you know what, it's time to sell this entire division. So what do? How do they tell their investors? Do they just pretend it's gone? Do they keep reporting its profits like nothing's changed? See, this is the exact kind of messy situation that accounting standards are built to handle. Because think about it, without clear rules, it would be total chaos. It'd be the Wild West of financial reporting. A company could easily make a struggling division look super profitable right up until the day they sell it. Or they could just hide the whole thing until the deal is done. And for you, as an investor, you'd have no way of getting a true picture of the company's actual health. It would be impossible to really compare one company to another. And that is exactly where IFRS 5 steps in. You can think of it as the official referee for these big corporate sell-offs. It's the international standard that makes sure everybody is playing by the same set of rules. It is all about transparency, really. It's about making sure that when a company decides to offload a big piece of itself, everyone, investors, analysts, you, gets a clear, consistent, and honest look at what's going on. So here's our game plan for this explainer. We'll start with the why, the whole point of these rules. Then we'll go through the super strict checklist something has to pass to even be called held for sale. After that, we'll see how it gets a new price tag, how it's shown off in the financial reports, and finally, we'll tie it all together to see why this is so important for anyone making decisions. All right, first up, the big picture. What is IFRS 5 really trying to accomplish here? So the goal is actually pretty straightforward. First, you've got to make sure these assets are valued correctly. We'll dig into that in a second. Second, and this is a big one, you stop depreciating them, period. And third, they have to be shown completely separately on the financial statements. It's all about creating a clean break and isolating the part of the business that's heading out the door. Okay, so a company can't just wake up one morning and decide to call something held for sale. It's not that easy. They actually have to earn that label by meeting some really strict criteria. Now, to get that held for sale classification, the sale has to be considered highly probable. And this isn't just a vague idea, it's a real checklist. Management has to have a formal plan in place. They need to be actively searching for a buyer. The price they're asking has to be reasonable. Oh, and there's a deadline. The sale should be wrapped up within a year. And finally, the company can't be wishy-washy about it. The plan has to be solid. And that phrase, highly probable, it's not just corporate buzzword. In the world of accounting, it has a very specific meaning. It's a much higher bar to clear than just probable. We're talking significantly more likely than not. This strictness is there for a reason. It stops companies from gaming the system and classifying things as held for sale just to make their books look better. And there's one more key ingredient here. The asset, whether it's a building or an entire business unit, has to be ready to go, like right now. It needs to be available for immediate sale in its present condition. You can't say something is held for sale if you still need to spend the next 6 months fixing it up. The buyer has to be able to walk in and take over pretty much right away. All right, so the asset has jumped through all the hoops. It's officially classified as held for sale. Now comes the big question. What's it actually worth? So the rule for putting a price tag on it is actually pretty simple, but it's really important. You look at two numbers. First, its carrying amount. That's just what it's worth on the company's books right now. Second, its fair value less cost to sell, which is basically the cash you'd have in your pocket after selling it today. The rule, you have to record it at whichever of those two numbers is lower. This is a conservative approach, and it's designed to make sure the asset isn't overvalued. And here's where things get really interesting. The moment an asset is classified as held for sale, you stop depreciating it. Just stop. The whole logic here is that its value is no longer tied to its use in the business. It's going to be recovered from the sale itself. This is a massive shift in how that asset is treated. Okay, so we've got the classification and the valuation down. But how does this all actually show up on the financial statements? Where do you, as an investor, actually see this stuff?
Well, the name of the game here is clarity. On the balance sheet, which you might see called the statement of financial position, these held for sale assets get their own special line item. They're pulled out from everything else and put under a spotlight. And the same goes for any debts or liabilities that are part of the deal. The rules are super clear. You can't just net them against each other. This separation makes it crystal clear what's staying and what's going.
Now, if the piece of the business being sold is really significant, we're talking a whole major business line, or the company's entire operations in a specific country, it gets a special title. It's called a discontinued operation. And when that happens, it triggers even more detailed reporting, especially on the income statement. And this is what that actually looks like. The income statement basically gets split in two. You'll see the profit from the core business that's sticking around. That's your continuing operations. Then, right below that on its own single line, you'll see the net profit or loss from the part being sold. This is fantastic because it lets you see how the main business is really doing without the numbers getting all muddied up by the division that's on its way out. Okay, so we've covered the rules, the checklists, the way it's presented, but let's zoom out. Why does any of this really matter? What's the big takeaway here? When you boil it all down, it's about one thing: clarity. IFRS 5 basically draws a bright, unmissable line in the sand. Over here, you have the business that's staying, the one the company is betting on for the future. And over there, you have the part that's leaving. That separation is absolutely critical for making smart decisions. And for you, the person looking at these reports, the payoff is huge. First, you get to see how the core ongoing business is actually performing, with no distractions. Second, it stops companies from hiding a struggling division by burying its bad numbers inside the good ones. This all means you can make much better predictions about future profits, and it creates a level playing field so you can compare companies fairly. And in the end, it all circles right back to the official objective of the standard itself. Everything we've just talked about, the strict checklist, the careful valuation, the separate presentation, it all serves that one main goal: to give us clear, specific, and honest accounting for these exact situations. So, let me leave you with one final question to think about. We've talked all about the tough rules for putting something on the for sale list. But what does it tell you when a company suddenly pulls something off that list? What kind of story does that tell about their strategy, their confidence, or maybe what they see coming in the market? That, right there, is the power of knowing how to read the story behind the numbers.